So 2 trillion deficit, right? So all that money is being basically shoved into the economy. So you got the passive economy, and then you got the stimulus from them. Then you got the Fed in the background going, "Don't you guys worry. You need anything? We'll pump up the volume." Walsh comes into office and he says, "Oh, I'm going to go after that. I'm going to go after that inflation. Inflation is my number one priority."
True.
Look at the Fed's balance sheet since he came in. With the Fed, if the Fed's balance sheet is increasing, that means they're printing money. So the Fed's like, no, there's inflation. They don't care about inflation. They're printing money. And Warsh actually even said that, he's basically Milton Friedman. It's a monetary issue. When you print money, you create inflation. When you expand the money supply, you create inflation. The Fed's been ignoring Friedman forever. They don't even talk about the money supply. Now, Warsh said we got to start talking about the money supply. Bottom line is this, is that our economy, 71, 87, 2006, it broke. And gold's going to be the winner. Now, look at the US dollar. Since 1971, the dollar's dropped 86%. Since 1971, 86%. So the stock market is it what if you look at the numbers, it looks like it's doing fantastic, right? But now value it in gold. It's down 86%.
Right.
So it's broken. And that's the reason why I own gold and miners.
What if the biggest risk facing the U.S. economy isn't the next recession, but a financial system that's been quietly changing for decades? In this interview, investor Durrett argues that years of Federal Reserve intervention, rising government debt, and the explosive growth of passive investing have created vulnerabilities that most investors are ignoring. He believes these forces could eventually reshape financial markets and make gold one of the biggest beneficiaries. Whether you agree with his conclusions or not, his warning raises an important question. Are today's markets stronger than they appear, or are we witnessing the early stages of a much bigger shift?
In my opinion, the only reason to own gold and silver miners, if you will, is if you don't believe in the US economy. If you believe in the US economy, you really feel confident that everything's just going to keep going, everything's fine, stable, don't worry about it, then don't get into gold and silver miners. I don't believe. I really believe that belief is important because of the volatility. Remember, I said that, we've had this correction, this 36% correction since January, and it hasn't bothered me. The reason why it hasn't bothered me is because of my conviction slash belief that gold's going to end up being the winner. Now,
Right.
if you look, I look at history. So one of the reasons why, so I was 20 years old in 1980, and that's when Reagan came into office. And so I've lived, so I went to college in the 1980s during the Reagan period. So I experienced the pivot into globalism, the pivot into basically money printing. And I experienced the Greenspan put in 1987. So the Greenspan put was, we basically went down 22% in October 87. And Greenspan came out the next day and said, "Don't you guys worry about the stock market. I got your back. I'll print whatever's needed." Stock market immediately turned around, went up. From that day forward, they call it the Greenspan put. Don't worry about the stock market. The Fed basically said, Greenspan said, "Don't worry, the stock market goes down, I'll do whatever it takes to get it back up."
Yeah.
And then we didn't have any problems until 2001. And then Greenspan, then he started lowering rates. That was his signal, that Greenspan put, was that he will lower rates to help to support the stock market. And it worked, and it created a massive bubble from 2001 to 2007, the housing bubble. He took interest rates down to 1%, created that housing bubble, and he printed, like crazy. And
Yeah.
then everything. And then we had the great financial crisis. Well, that's basically the Greenspan crisis, from basically taking rates too low to put too much, which is what we've done ever since. Basically, bubble, bubble, bubble. We basically been living on bubbles. So Greenspan, he told us, and he was in office from 87 to 2006, and he pretty much told us what he was going to do. I'm going to lower rates and print money, and don't worry, everything's fine, right? And he got away with it because we didn't have any inflation during his era. From 87 to 2006, there was no inflation. So the Greenspan put was absolutely in place. But he also set a precedent. This is the reason why you want to own gold. He basically he set a precedent that the Fed would manipulate and manage the economy. That forget about free markets. We're not using free markets here, people. We're using the Greenspan put, right? And then Bernanke comes in. Now, isn't Bernanke a really interesting guy to come after Greenspan? If you think about it, he was in love with the Bernanke put. Greenspan, Bernanke, he wrote his thesis. His thesis was that the Depression shouldn't have ever happened. That all they needed to do was print money, and they could have avoided it. It was a liquidity problem, right? Which is exactly what the Greenspan put is. And so Greenspan comes in 2006. He's ready to print like crazy, which is what he did. Basically took rates to zero, which is the Greenspan thing, right? Use rates and use printing. So Greenspan really was the guy that really destroyed the U.S. economy because he rug pulled the free market. And then
kind of like Mario Draghi in Europe.
It was a very similar thing, very similar. And then Bernanke came in and said, "Don't worry, I got your back. I'm Greenspan on steroids."
Don Durrett's argument begins with a long-term view of how the U.S. financial system has evolved. He believes decades of Federal Reserve intervention from the Greenspan era onward gradually changed the relationship between markets and government policy. In his view, these actions encouraged investors to expect support during downturns, making the financial system increasingly dependent on low interest rates and liquidity. Whether viewers agree or not, this historical perspective forms the foundation of everything he says next.
Those two guys together were the tag team that destroyed the U.S. economy. And if you can see it, if you have eyes to see, if you do the research and you look at what's really happened from 1987 till now, you can actually go to 1980 and you can go to Nixon in 71 when he took us off the gold standard. If you really look and see, the only thing that's keeping the stock market up right now, it's twofold. First thing is passive investing. So we got 60% of the stock market is passive investors. It's all passive funds that just keep coming in. Now, passive funds, they don't care what the stock market's doing. All they care is every month a 401k plan goes, okay, here, put in $100, put in $200. They go, buy. They never sell. All they do is buy. And so when you got 60% buyers, no, they're not sellers, they're only buyers. And when you put that in tandem, right? So we got all the passive investors, the 401ks, pension funds as well. When you have that many passive, when you put that in tandem with the U.S. government, with this fiscal dominance where they're basically borrowing $2 trillion. So we have $5 trillion in income, $7 trillion in payouts. So $2 trillion deficit, right? So all that money is being basically shoved into the economy. So you got the passive economy, and then you got the stimulus from them. Then you got the Fed in the background going, "Don't you guys worry. You need anything? We'll pump up the volume." Walsh comes into office and he says, "Oh, I'm going to go after that. I'm going to go after that inflation. Inflation is my number one priority." True. Look at the Fed's balance sheet since he came in. With the Fed, if the Fed's balance sheet is increasing, that means they're printing money. So the Fed's like, no, there's inflation. They don't care about inflation. They're printing money. And Walsh actually even said that, he's basically Milton Friedman. It's a monetary issue. When you print money, you create inflation. When you expand the money supply, you create inflation. The Fed's been ignoring Friedman forever. They don't even talk about the money supply. Now, Walsh said, we got to start talking about the money supply. Bottom line is this, is that our economy, 71, 87, 2006, it broke. And gold's going to be the winner. Now, look at the U.S. dollar. Since 1971, the dollar's dropped 86%. Since 1971, 86%. So the stock market is at what if you look at the numbers, it looks like it's doing fantastic, right? But now value it in gold. It's down 86%.
Right.
So it's broken. And that's the reason why I own gold and miners, because it's just, people say, well, this thing is never going to break because of the passive income. But 20% of that money in the stock market today is foreign money. That foreign money, that's That's the risk here, is if we ever do go into a recession, people say, well, we're never going to go into a recession. But if we do go into a recession, that foreign money is going to leave. And when the foreign money leaves, because the foreign money is only here to make money. They're like, oh, let's rotate out. Stock market's down 10%, 15%. We got to rotate out. Foreign money starts leaving. And then at that point, the passive money turns. There is nobody backstopping the passive money. Nobody. Nobody. So if the passive money turns and says, I want to sell, there's no buyers. It's too damn big. It's too damn big. With 60%, I mean, these funds are just uber massive. So if they decide to sell, there's nobody on the other side. And then you have the derivatives. It's the house of cards.
Building on that idea, Durrett shifts his focus to today's market structure. He argues that massive government deficits, the growth of passive investing, and continued monetary support have created a system that appears stable on the surface, but could face significant stress if investor confidence changes. His concern isn't about a normal market correction. It's about what could happen if those structural supports begin to weaken at the same time.
That's an interesting point you just made, Don, about the size of the average ETF or mutual fund. That is something I talk about, is like 0809 was hard enough to get out of things because there was a lot of similar ownership from Vanguard to Fidelity to Merrill to BlackRock, right? Like they own a lot of the same names. But imagine fast forward to today when you have so much more wealth in the market. How do you get out of that? I mean, the algos are going to crush these things. Take a look at Liberation Week. That was what's going to happen. Liberation Week did not have a care whose stock what they were. The algos were just trashing everything. Apple down 24% in 5 days. I mean, I think that if you have a prolonged situation like that, where it's like you've talked about this, where you have months or years of a malaise, that is going to freak people out. It's just that we have these 4 to 8 week, sometimes 1 week, like we're talking about, corrections, and people are like, "Oh, it's fine. Fed's got our back, market's got our back," and I guess that's the question. The last question we'll ask is, how is that going to change, right? How is that going to change into what you see for the future? Like, how do you see it evolving into a longer correction?
So, the guys that I really respect are the guys that have been here, since the 60s, right? Really been around the block. I mean, the Jim Rogers, who's considered one of the better commodity traders of all time, Warren Buffett, one of the best investors of all time, Jeremy Grantham. These guys have been around the block. Mark Faber is another one. These guys are old timers. They've been through it all. I mean, and they've been doing this full time their whole life. And all of them are basically saying, oh, holy crap, we got a problem here, man. Simultaneously, so these guys are all saying, watch your back, watch your back. And simultaneously, the boomers have all their money in the stock market. They're ignoring these guys. They're ignoring them. They're like, those guys don't know what the hell they're talking about. We're fine. We're just going to keep making money. And everybody's overweight. Everybody's in the stock market. Here's the one thing that really should get your attention.
Okay.
Is that from 1945 until recently, especially until 71, but even then further, the U.S. economy and the global trade system has basically been in the U.S. favor, where the U.S. basically dominated the hell out of it. They dominated, cross-border trades with SWIFT. SWIFT used to be like 98% of trade. SWIFT dominated everything. The U.S., their power around the world, their naval force and their air force was so potent that nobody would mess with us. Everybody would do what we wanted. We had basically influence, massive influence. That influence is on the wane. And that influence is on the wane. The de-dollarization is happening. We're seeing more money go, central banks go into gold than go into treasuries. We're seeing foreigners slowly get out of treasuries. The geopolitical problem is not getting better, it's getting worse, right? And so when you combine the geopolitical stress with the underlying stress of the US economy, you can see the whole thing's going to blow up. The question is when. You're not going to prevent it. The reason why you're not going to prevent it, there's only one thing here. and this is really it's really fascinating. It's like history rhyming again. Is that the AI trade? The AI trade is almost identical to what happened in the late 90s when you had the dot-com bubble, right? Now we have the AI bubble. And that dot-com bubble it bursted in January 2000 until 2008, right? It created havoc, right? This bubble is going to create havoc as well, but a lot more damage. And the reason why it's going to create a lot more damage is because geopolitically. So in 2008, the US was just the dominant superpower,
Yeah.
just the dominant. And so we could basically get through that era with basically no unscathed, if you will. But we had to keep printing like crazy. This time, we're not going to be unscathed. And so this is the reason why gold is doing what it's doing right now, performing well. But it's early innings. We talked about these stocks that like nobody wants to own them. Are you crazy? Um, this is the most asymmetrical trade since the market-backed securities, 2005, when
Yeah.
Michael Burry basically, I don't know if he actually said that in real life, but in the movie he said, "Don't worry, it's a certainty." I hope he said
Yeah.
it in real life, but
But you
that's
remember
kind
with Burry in the movie, and I don't know his actual numbers, but in the movie he lost a lot of money
of early.
going into the correction.
To strengthen his case, Durrett points to experienced investors who have warned about elevated market valuations and growing financial imbalances. He also compares today's enthusiasm around artificial intelligence to previous periods of speculative optimism, while emphasizing that history doesn't repeat exactly, it often rhymes. For him, these trends reinforce the idea that investors should pay attention to risks that may not be obvious during strong market conditions.
Much like investors are down heavily on stuff since March 1st right now, right? Like you're carrying what you're holding the bag, as we say in finance, right? Like you're bag holding.
Right.
However, you have to have like an ability to, like you said, have a discipline, a strategy, Don. They're kind of interchangeable words to look at your stock holdings and do an assessment with a professional like yourself or myself and say, look, I bought it for this. Is the thesis still intact? If the thesis is still there, you have to add. You can't just buy it once. Like that's a broken strategy, in my opinion. I see this all the time. Well, I bought it here, and so now I'm carrying a 40% loss. Right. We don't make perfect entry points either, Don and I, right? Like we don't. So
Right.
you have to look at it and say, why did I buy it to begin with? And if the reasons are still there, you add. And I usually add the same amounts, right? So if I put 5,000 shares in it here, and then I'll put another 5,000 shares or even more down here to get my blended cost basis better.
Right. I plan to walk away. Like Burry, when he sold all his market-backed securities, he sold them all. He was done. That trade's gone. That's in the past. That's how I feel about the gold silver miners. I plan to sell all of them between $7,000 gold and $8,000 gold,
Right.
depending on the multiples. If the multiples are still weak at 7,000, then I'm going to have to be patient for the multiples to expand because I don't want to leave early. I know what a market looks like at a top. And at a top, it gets really frothy and the multiples get kind of dicey, like what we're seeing today. If you look at the PE multiples, they're high, right? That's what I'm waiting for. But
Right.
you want to be smart when you buy and smart when you sell. But the vast majority of people are going to be chasing this thing. Like I said, I'm not going to be buying anything. Once we get above a certain level, I don't know when that'll be. I'll just be done buying. And that's when everybody else is going to be buying. Everybody's going to be chasing this stuff. You want to buy now when you can buy cheap now, and you want to hope we go lower. You want to hope we get another correction. I think we will. But, you know, I basically learned to buy dips because I've been doing this for so long. We talked about it earlier in this podcast. But yeah, you got to buy smart and sell smart. Buy these stocks cheap when you can see that they have a lot of alpha. And then you don't want to sell too early. You want to wait, be patient, and sell when they're to the top. Now, the one caveat I would make on selling early is if you lose faith that a stock doesn't have a lot of alpha left. You know, if
Right.
There's no problem swapping a stock out. Say you bought a stock and you've held it, it's up 100, 200%, and you look at it, and you analyze it, and you go, this thing really isn't really going to rip that much in the next 2 years, right? I probably should swap this for a 10 bagger. There's nothing wrong with doing swapping, but don't swap. Like I do a Saturday night live podcast, and a guy wanted to swap a high quality producer, for a 10 bagger. No, don't swap those guys because the high quality producers, we don't know how high gold and silver are going to go. And
Right.
so if gold and silver, if those overshoot, you want to own those producers because those are the guys that are going to participate. You want to sell the exploration stocks. Those are the ones you want to swap out of. Or a developer that has if it's already ran, that has a high capex, it's not going to go into production until 2030, 31, 32. Those are the ones you want to swap.
Yeah. Okay. Good advice. We'll leave it there.
Finally, he explains why patience and discipline, not emotion, are central to his investment strategy and why he believes the biggest opportunity may still lie ahead. Throughout this interview, Don Durrett presented a clear and consistent thesis that decades of debt expansion, monetary intervention, and structural changes in financial markets have created risks that many investors continue to underestimate. Based on that view, he believes gold and select mining companies could benefit if confidence in the current system weakens. Of course, these are his opinions and investment outlook, not guarantees of what will happen. As always, every investment involves risk, and viewers should do their own research before making financial decisions. If you enjoyed this analysis and want more in-depth interviews on the economy, precious metals, and global markets, don't forget to like the video, subscribe to the channel, and let us know your thoughts in the comments below. Thanks for watching.